All right, so our summary of our outlook. Potential volatility, both upside and downside. We saw that just in the last few days. We think that we're coming back to the norm where we'll see that throughout the year. We have U.S. fiscal and monetary policies, as Marty talked about. We're going to see interest rates going up. You're going to see the tax reform bill go into effect. And what we're doing is we're rebalancing into our strengths, buying on weakness, and we don't panic. And I shared with you with the question that we had a little while ago. We did just that. We sold out of some investments that we were looking for the right time to get out of. We held that cash. We waited. And then on Friday, when we saw that market go down 500 points, we put it to work. The market reversed soon after, Monday, and today the market was up. We'll see what happens tomorrow. The strong labor market with rising wages will support economic growth, but may raise inflation expectations. We remain overweight in stocks compared to bonds, although we did make sure we bought the full, what our target is for bonds in the portfolio, so clients will have that comfort level of when they see the volatility, they'll know that they own the amount of bonds that you're comfortable with. So if you're in our growth and income strategy, right now we have a target of 65% stock, 35% bonds and cash. Equities are fairly valued, as Ryan said, but they have the potential to move higher with all the earnings that Ryan showed us, the history of corporate earnings. And corporate earnings have been healthy. So what are we doing with everything going on? We're going to increase a little bit towards international. We've been underweight for quite some time. We're still going to be underweight international equities. We're going to watch it closely, but we feel that there's more value there than the U.S. stock market, and we think it should pay off. We continue to be cautiously optimistic. Sometimes we'll get into a position and get out soon thereafter, and there's always a good reason why we do that. So when you see us do that, don't think that we're losing our minds. We're healthy, we're very spirited in our investment committee, as you can only imagine. The beauty about having 4 of us every week talk about the investments is usually we all have different opinions. And it's nice when one of us is able to have somebody else think about things differently. So when I tell you we have spirited investment committee meetings, someday we should tape one, and you'll see just how much thought goes into our investment process. At the end of the meetings, we're very confident in the decisions that we do. But we're always cautiously optimistic, and if we see something pop up unexpectedly, you'll see us take some risk off the table, and we won't think twice about that. If you have cash needs for the next 2 years, you shouldn't be invested in the stock market. I know for each and every one of our clients, they are not invested in the stock market. We always ask clients, what money do you need for the next 2 years? We're going to carve that out, make it very, very conservative. If you're within 2 years of retirement, you may want to look at your portfolio. But as I always say, just because you retire doesn't mean you plan on dying. You just plan on starting a new career, and that's retirement. And hopefully that'll be a good 20, 25, 30-year career. This is a good time to invest cash. We put our cash to work, and we may still see some down days. We're not sure. We don't have a crystal ball. But even before the volatility, we were optimistic. With the volatility, it was an opportunity for us to get in at lower levels, better valuations than where we were, because the fundamentals of the economy are still solid, and the volatility we've seen over the last week and a half is really just with the threat of interest rates rising. Now, this month's jobs report, when it's released next month, could show a different picture. We don't know. But we're always keeping our eyes on the ball. With the new tax laws, this is a good time to meet with your accountant. And if you're doing your taxes on your own, you may want to think about it with the new tax laws. There's so many deductions and everything that are missed. And now with the new tax law and all the changes, you don't want to miss anything. And if you haven't sat down with an estate planning attorney, if you haven't dusted off your will, your living proxy, your healthcare proxy, I should say, your living will and all of that, if you haven't done that over the last 5 to 10 years, you may want to dust it off and kind of freshen it up. With the tax bill impact, the good, shifting income to lower tax brackets, the child tax credit moving from $1,000 to $2,000, which really gives those people that are having children, a credit is money in your pocket. A deduction is a write-off, so that's good. The bad, the AMT changed but not eliminated. Elimination of miscellaneous itemized deductions. You may need to consider this if you were deducting. For instance, our advisory fees used to be a write-off. Capping of the state and local income and property taxes at $10,000. In New York, you're hearing a lot about this. That's bad news. Basically, a lot of your write-offs are taken away from you. Why is that? Let's make believe that all in, your state, local, and property taxes amounted to, $20,000, and you're married. Well, Uncle Sam now is giving you a standard deduction of $24,000, so you're not going to write that off because they're giving you $4,000 more as a standard deduction than you itemizing it. Let's make believe it's $30,000 and you're capped. Well, now you're kind of hurt because you're really going to lose out on some of the write-offs. This will affect a lot of people differently, and it's one reason why you're seeing so much talk about people that have those high state, local, and property taxes that now are capped at $10,000. They can't write them off, and they may be moving elsewhere, not because of the snowstorms and everything else and the cold that we saw in the beginning of the year. So the unknown is really that higher standard deduction. It's potentially good, potentially bad. We'll see. The conclusion, it's supposed to be good for the U.S. taxpayer, obviously bad for New Yorkers. Now let me get into some of my favorite slides. This goes back 38 years. You heard each and every one of us talk about volatility being healthy, being normal, but something we haven't seen in 2 years. This shows you that the average peak to trough, high to low swing in the stock market in any given calendar year over the last 38 years is down 13.8%. That's the swing from high to low in the average year over the last 38 years. That's a pretty good statistic. Obviously, last year was down 3%, the year before that 11%. You kind of get the idea going back 38 years. So we were down 10.4%. That's normal. Now the year's not over. We may hit lows again. I'm not saying this volatility has ended. I'm just saying when you see it, don't be afraid of it. And because we haven't seen it in a couple years, you might have forgot how it felt, but I think Marty said it's a good time to do a gut check. If it really kept you up at night and you can't sleep, maybe we need to readdress your tolerance for risk. But otherwise, this is normal. We're not concerned about it. It's been a long time coming. It's actually healthy for the markets. Market timing is a losing proposition. You hear us say that all the time. When you look at the richest people on the Forbes list, there's never a market timer on there. If they knew how it worked, you would think they would make money at it. So if you had a $10,000 investment beginning in January of 1997, and you were fully invested, your return on average was almost 8% a year. Your $10,000 grew to almost $44,000. Now, what if you missed the best 10 days of 1997? Instead of having 44,000, you would only have about 22,000. Your average return actually dropped by from 8% to 4%. If you missed the 20 best days, you'd have about 14,000. and so forth. The 30 best days, 40 best days, 50 best days, 60 best days. So we are fully invested right now because we're optimistic. If we were thinking that there was a great recession on the horizon or something that would stop the stock market from going up, you would see us take risk off the table. But we actually are invested to our targets because we feel that the year should be good. Fundamentally, the economy is good. Corporate America is earning money. People are going back to work and they're being paid more. That's all good news. And interest rates are going to go up. That's okay. We'll get beyond this. This is something to think about. 6 of the best 10 days occurred within 2 weeks of the 10 worst days. Just think about that. Can you imagine? So I'm going to tell you a little story. I had a client call me. Only one client last week called me wanting to jump off the cliff. I stopped him. I said, "You're too young. You'll die." So I stopped him from jumping off that cliff. And I think it was Tuesday after the market was down 1,200 points. "Steve, I can't take another 2008. I just can't." Now, this is a young guy. I said, "Listen, don't worry. We're nothing like 2008. There were a lot of different things going on then." "All right, I feel good. You know, we're good, Steve." I said, "I know." I said, "We're going to be good." So we're getting ready to do the presentation Thursday night. And before I'm getting ready to turn off my phone, the market was down 1,000 points on Thursday. I get the text. "Get me out of everything Friday morning. I've had enough. I can't take it, Steve. Just sell everything." So I called him Friday morning. He wouldn't return my call because I had to talk to him. I couldn't just, take orders over a text. So he finally called me back later in the day. Now, the market went from being up, down, down, 500 points, and then all of a sudden it turned around. And he calls me just about when the market's going to close. I said, "How are you feeling?" He says, I'm not sure. He says, "It's crazy." I said, "I know." I said, "So this is what we're going to do. I'm going to send my IT guy over to your house. We're going to put a parental control device on your TV so you can't watch CNBC. CNBC is in the business of entertainment. They want you to be scared to death because otherwise you're not going to tune in." Does anybody ever read the good news in the newspaper? Well, first of all, there's not much good news in the newspaper. But does anybody read it? No, they go for those horrific headlines. Well, that's what CNBC is. Jim Cramer's a smart guy. But don't take investment advice from him because every night it's different. So, make a long story short, he promised me he wasn't going to look at his accounts for 2 weeks. I said, "Let's make it 2 months. We'll see." Now, I haven't heard from him since, and I told him that, there's a lot of good shows during the day, Ellen and Oprah and the Food Channel. I like to cook. I said, do something different. So just think about that. 6 of the best 10 days occurred within 2 weeks of the 10 worst days. We were down 1,200 points on last Monday, 1,000 points on Thursday, up 330 points on Friday, up, how many yesterday, 400? 400 yesterday. Can you imagine missing those days? You can't make that up, folks. And that's why you won't see us panic. So this last slide, markets, when they decline, it's really only temporary. As you can see, the blue are the rising bull markets, let's say, going back to 1930. The red are recessionary times or corrections or bear markets. And when you look at this, basically what this is showing you is stocks are up more than they're down. The stock market has recovered from everything that has happened. You go back to 1930, we had a Great Depression, world wars, regional wars, oil embargoes, presidential assassinations, technology bubble, financial collapse, real estate getting out of whack. I'm pretty sure the stock market's going to recover from higher interest rates. I don't know how long it'll take, but the market, as you can see, has recovered from everything. That's history, and I can't imagine anything. If you've survived the Great Recession, which was the absolute worst time we've seen in the market since the Great Depression, you could survive this little interest rate hike. And we're going to get it, and the volatility will probably go back to normal, and that's okay. And then last but not least, the olive green line. This is 1 year, 5 year, 10 year, 20-year rolling periods going back to 1950. So you can only imagine, well, you know how many 1-year rolling periods there are. But 1950, 1951, 1952 starts a new 5-year, a new 10-year, a new 20-year rolling period. You get the picture. There's a lot of rolling periods. The worst year in the stock market was down 39%. That happened to be recently, back in 2008. The best year in the stock market was 47%. If you were just invested in the stock market from 1 year, you could have been down 39 or up 47. This is why we say if you need your money in the next year or so, don't have it in the stock market. We don't know when this is going to happen again. But for bonds, the worst year was down 8%, the best year 43%. The gray is a 50-50 portfolio. So over a 5-year rolling period, the longer you own stocks, the less volatility. Down 3%, your worst 5-year rolling period. That's one 5-year rolling period. I don't know how many 5-year rolling periods there are. I should try to figure it out. So the worst 5-year rolling period, down 3%, the best up 28%. For bonds, down 2, up 23. 10-year rolling periods, the worst, down 1%, the best up 19% annual returns. For bonds, up 1%, up 16%. And last but not least, 20-year rolling periods, the worst, you still made 7% a year, year in, year out. The best, 17% a year, year in, year out. For bonds, the worst, earning 1% a year. For the best rolling period, up 12% a year, and in a 50-50, as you can see. So on average, your returns going back to 1950 in stocks was 11%, bonds 5.9%, a 50-50 portfolio 9%.